Thank you for joining us for a brief update of third quarter 2022 markets. I'm Marc Balcer, Director of Investment Strategy here at Girard. It's been a punishing first 9 months of the year, and while we expect better market performance, we know it will come with volatility. We hope to serve as a guide and trusted resource on your financial journey. Our experience is that having a resilient wealth plan can help when facing the challenges of an extremely volatile market landscape. With such a plan in hand, we can respond to unexpected circumstances thoughtfully instead of reacting impulsively. Reach out to us by visiting www.meetgirard.com to learn more about how we work together to achieve your financial goals. Last quarter represented the third consecutive quarter of declines with almost nowhere to hide. The last time we saw 3 quarters of declines in the S&P 500 was in 2008 and 2000. This year, Morningstar data shows that 93% of asset classes are down. Bonds have followed stocks downward for the first time in over 50 years. No doubt, uncertainty regarding Ukraine and lockdowns in China presents a challenging backdrop, but the primary driver of this broad decline has been global central bank response to ongoing inflation. As rates move higher, the value of future income streams declines, leading markets to mark down equities, debt, and even commodities. Digging more deeply, a 2-month rally off mid-June lows screeched to a halt when Fed Chairman Powell offered hawkish remarks at an August conference. Powell's insistence that the Fed aggressively attack inflation, even if it means increasing unemployment and slowing economic growth, gave investors pause across our investable universe. While Q2 earnings season was relatively strong, as the quarter wore on, we saw warnings from bellwether companies reflecting on slowing growth, negative impacts of dollar strength, and margin pressure. We continue to suspect the economy is due for a hardish landing as the Fed pushes rates higher and the prospect for additional government support is limited. The window for a soft landing has likely closed. This doesn't necessarily mean investment markets will underperform. It is likely most of the damage has been done, and history tells us that investment performance coming out of rate hike cycles and recessions is quite positive. Coming into the year, investors were willing to pay over 20 times next year's earnings on the S&P 500. This price to earnings, or PE multiple, has dropped to the mid-teens, in line with the average PE over the last 20 years. As shown in the table, what this means is that all of this year's price decline has come from valuation, or what investors are willing to pay for a dollar of earnings, rather than a decline in corporate earnings. Meanwhile, the S&P 500 growth has been positive in terms of earnings, in the 5% range. There are logical explanations for this valuation decline. All of this year's earnings growth and more has come from the energy sector, where earnings are volatile and generally earn a lower valuation multiple. And, as always, investors are looking into the future and predicting slower growth or even declines in future years. Finally, higher interest rates have made the present value of future corporate cash flows much lower. We've just begun to see analysts incorporating a slower economy into their individual company earnings estimates. Through the end of September, negative estimate revisions remained modest but clearly turned negative. We have seen movement in Q3 earnings estimates, which have dropped 7% over the last 3 months. We wouldn't be surprised to see these levels of earnings declines in a recessionary scenario. What is difficult to ascertain is, have the valuation declines that we saw on the previous page been embedded into these expectations? We think the answer is yes, as long as inflation begins to decelerate and employment cools off. Turning to the bond market, double-digit declines have largely been driven by rising rates off of a low base. At the beginning of the year, the Fed's dot plot suggested 200 basis points of rate hikes over the following 2 years. Each quarter since, that line has moved up. We've seen a meaningful increase in this expectation, which now has us expecting a 4.5% terminal rate sometime early next year. The Fed is targeting inflation and the bond market has been its victim. Bonds have become much more attractive as credit quality remains high and yields have increased materially. This is just a sneak preview of our view on the economy and markets, which we'll elaborate on in next week's market outlook. As we look forward, the global economy is under pressure, but we've seen this playbook before, and we know that economies tend to self-correct. While every bear market is unique, they all have shared one thing in common: they end. We know that markets bottom before the economy does. And given poor sentiment, improved valuation, and resilient corporate balance sheets, especially in the US, we expect that we're closer to the end than the beginning. That's all for now. Thanks for tuning in to the first of this quarter's Investment Current series. We'll see you again next week. In the meantime, we encourage investors to remain broadly diversified with careful planning for short-term cash flow needs, balanced against goals of long-term investment for future goals. We'd love to help, so please contact one of our advisors by visiting www.meetgirard.com. Thanks for watching.